Hello and welcome to a fresh new edition of Trading Hour. I'm Prashant. With me, my colleagues Reema and Pavitra. Guys, hi. Good morning. Reema, of course, is standing on the big wall, and I don't know if you can show her. IT, of course, is the focus area over the next couple of days, and we'll get you what to expect from the top IT services names, starting TCS early next week in just a bit from now. Markets doing nothing. It's pretty quiet out there, although in the first 2 hours or so, we've already seen a fair bit of move. I mean, the market started lower, then the market went up. There was a sell-off. And we are there now, down 50 points, 17,941 or so. In very simple terms, the level to watch really is yesterday's low, which is 17,961 or so. We will see if those levels by close are held or not. It's too early in the day to kind of say if the market is able to hold on to these levels or we see further correction. But 76 points lower, we are at about 17,915 right now. Reema, Pavitra, good morning.
Hi, good morning. Like you pointed out, there's been quite a drop from the top. And a bulk of this pain is actually coming through from the banking names, right? So a few of those will be up on your screen. This is something that we saw play out yesterday as well. So those stocks in focus. What is doing well, however, are the consumer names. So that is actually the only sector which is holding up in the green. So some of the larger names will be up for you. Reliance is also another one which is, really adding some support to the markets. That one is looking good. And the insurance space continues to do quite well. So something like an HDFC Life once again is doing well. For the week, it's up 9%. Even something like an SBI Life has seen a 4% move. So do watch out for that space. On the downside, like I said, it's tech and also the banking space. In terms of cues, we will get the US jobs report today. So that is important to watch. And then, of course, earnings season kickstarts on Monday. So it will be a lot about IT. But speaking of that, like I said, it is going to be IT which kickstarts earnings season for us on Monday. TCS will be first to go on the 9th. And then we will have Infosys and HCL Tech on 12th and Wipro on the 13th. The big question is the slowdown easing or worsening, and is the slowdown already priced in after the 30% underperformance last year? Reema's moved over to the big wall, and she is here with all of the key expectations from big tech in Q3. Reema.
Thanks so much for that. So let's tell our viewers what we can learn and hope to learn in this quarter's results and commentary. Now remember, Q3 is typically a soft quarter seasonally. But this quarter, growth rates will further moderate given the higher furloughs. Remember, HCL Tech has already highlighted that we are seeing higher furloughs in 3 key verticals. They spoke about high-tech, BFSI and telecom. Now let's pull up the CNBC-TV18 estimates on the growth expectations this time. The top 5 IT companies are anticipated to report a growth anywhere between 0.5% going up to 3.5% for HCL Tech. But if you compare with this December of last year, where the growth rates averaged from 2.5% going up to 6.5%, you would see that growth is slowing down. That's point number 1. So what do we want to hear from the management to understand the future demand? 1, will the furloughs continue into Q4 as well? 2, how are the tech budgets for this calendar year? If the tech budgets are flat, and if they're not growing, and if large deals are absent, can IT companies see double-digit growth next year? Number 3, is there a moderation in the deal win outlook? And what about pricing? Is pricing under pressure? And finally, watch for the hiring numbers because they are a proxy for future demand. Now let's talk about the margins and the expectation. Now the CNBC-TV18 poll throws up that margins are likely to expand for the 2nd consecutive quarter for the IT companies. This is aided by an INR depreciation and 2, declining attrition. So TCS's margins are likely to expand by 70 basis points. For Infosys, margins are likely to go up by 30 to 40 basis points. Now, while margins are improving, a point which has been made by the IT bears is that margins are still significantly off compared to the peak levels that they hit post-COVID. Remember, in the immediate aftermath of COVID, IT companies had cut back on hiring, salary, travel costs were zero, and margins had surged. Now, the question is there scope to improve the margins from current level, given that attrition is on a declining trend? Or will growth offset any margin improvement because you need operating leverage to kick in to improve margin? Now let's talk about the guidance. The annual guidance is given by Infosys and HCL Tech. Infosys is likely to retain its FY23 guidance on revenues and margins, and so is HCL Tech. HCL Tech, in fact, just last month had already tweaked its guidance, right? They had indicated that growth rates this year will be at the lower end of their guided band. So don't expect any change. Wipro gives you a quarterly guidance, and next quarter's guidance is likely to be muted at 0 to 2%. But as we've been saying, the question is really on future demand, FY24 and FY25. And here, unfortunately, the results are unlikely to give you any strong quantitative signal on FY24 outlook. And then let's move on to the stock price and valuations. Now, last year, the Nifty IT underperformed. The Nifty IT index was down 25% versus the Nifty, which was up 5%. Now, the Nifty IT has underperformed the markets consecutively only once in the past 15 years. So will this support a trend reversal? Can Nifty IT recover? Or given the fact that despite the correction, valuations are still at a premium to historical levels, will we see valuations correct back to their pre-COVID levels, driving a weakness in the stock? Back to you.
All right, Reema, thanks a lot for taking us through that complete roundup on what is expected from the big tech companies in Q3. But to discuss more on this, we're also joined by Devang Bhatt of IDBI Capital. Devang, good morning and thank you very much for joining us. This is Pavitra. I'm sure you heard what Reema had to say in terms of what is expected from the tech sector. And, of course, growth slowdowns are penciled in across the board. But can you tell us what is the kind of slowdown that you are estimating from at least the bigger tech companies?
Yeah, good morning, Reema. So what we are expecting is that Q3 this quarter would be around, 0.7 to around, just 2.8, which is 2.8% is because of HCL Tech, which has a higher product revenue growth. So mostly IT services will be around, 0.7 to 1.5 kind of a growth. So it will be far lower than what Q3 last year was because of, now what is expected is normal furloughs, which was there in COVID times. And the macro is also slowing down the discretionary spends.
Is there a risk of earnings downgrades this time, Devang? And what about valuations? If we do see some misses on the earnings front this time, do you think valuations will correct? What's the investor positioning like?
So valuation has significantly corrected. So what we had issued a report in around May that, the valuation will convert towards 5 years. So almost many companies have, corrected towards their 5-year average, which is, 10 to 15% kind of downside is maximum 5 to 10% kind of downside is there. So what we think is that, valuation is corrected, but the issue is that, earnings, considering that, all the clients that they have. So those clients will have certain specific challenges, and on that basis, earnings can turn around. And on that basis, valuation can, slip, considering the growth that they give in the coming quarters. So what we believe is, better to stick to large cap like Infosys and TCS, which, they are able to maneuver the slowdown or discretionary through cost takeout kind of opportunities.
So you said the maximum downside is about 5 to 10%, right? That's going to be earnings downgrades or valuations? Didn't quite get that.
So in terms of valuations, I'm talking about in terms of earnings downgrade, there might not be that much earnings downgrade because that has been already been, factored in the previous 2 quarters. So more from a valuation perspective, so that they will be near their 5-year average.
Devang, the other big question is on margin, right? I mean, we have spoken to most of the tech companies, even in the past quarter, they are talking about attrition, sort of that situation improving a little bit. Do you think that this is likely to aid margins and we will see an improvement in this quarter as well?
Yeah, so margins expectation is gradual that it will improve. This quarter, there will be some margin improvement. Going forward, there will be far higher margin improvement because, the supply side issues that were going on, that has receded. Plus, freshers have been inducted. And to a certain extent, the cost pressures that they were facing earlier, that has all receded. So we believe, margins are going to expand from here on.
How much of an expansion are you factoring in here for the margin?
So this quarter, we are expecting around 35 to 117 BPS margin expansion. Going forward, probably 100 to 150 BPS margin expansion is possible for FY24.
Would you buy into any earnings-related correction this time in the IT stocks?
So what we believe is, in terms of Europe, geography-wise, Europe will be weaker. So we prefer that, those companies which have higher US exposure and those who have higher BFSI or, healthcare kind of an exposure should do well. So if there is correction in such stocks, we would be a buyer in that.
Okay, and what is your reading on the mid-cap IT space as well? How much do you think we could see in terms of a downside on the stock performance?
So in terms of mid-cap IT, the issue is that, there are client concentration and certain clients might not perform because of, pressures in, say, mortgage or pressure in discretionary retail or pressure in, communication side. So we prefer those companies which have, which are able to maneuver this, like, those who have a vendor consolidation opportunity and they can maneuver that. Those who have good Fortune 500 exposure. And in terms of valuations, certain stocks have corrected well. So that's why we believe, LTI Mindtree to a certain extent should do well. Signed, and we have recently initiated a coverage on Newgen, which has lesser exposure to the developed world and more exposure to the emerging markets, and they can do well in terms of revenue growth. So at least 20% kind of growth this year they can do. So this should do well for them, and they have BFSI exposure, and their India and EMEA is doing well. So we are bullish on Newgen.
Okay, thank you very much, Devang, for joining in. Look forward to chatting with you as the numbers trickle in. Get into a break. On the other side, we'll discuss what's buzzing in the commodity space. Manisha Gupta joins in next.
Hey guys, welcome back. You're still tuned into Trading Hour. There's not much going on in the equity markets today, but that is not the case with the commodity space. Manisha joins us, and today she's talking about a commodity that has a lot of takers in the studio. Manisha.
Oh, well, absolutely, and it's Friday. Let me cheer it for you, especially you, Pavitra. So when it comes to coffee and sugar, we are looking at prices declining for both of these commodities, and quite sharply at that. So when you look at the international coffee prices, they are trading at around 16-month lows. We did see prices decline by 26% in the previous year as well, and this year has started on a weaker note, and that is because the Brazil weather has improved, the supplies have increased. With Brazilian real as well weakening, we have seen the coffee prices go down. Also, when you look at the ICE Arabica inventories, they have risen to 5.5-month highs. I mean, take a look at that. We've seen December inventories at around 814,000 tons. In November, it was just about 382,000 tons. So a lot of material really have come into the exchanges because there are no buyers or takers in the open market there, and that really shows the trend there. The markets are looking at weak demand, especially from Europe, good crop prospects, rising inventories, all of that seems to be weighing on prices. That's exactly the case that we are looking at in case of sugar as well. The month of December did see very strong prices. We did see a 2-year highs in the international markets, but the prices have come down quite strongly. There's a huge amount of profit taking from commercial buyers and speculative traders there. So from 21.5 to 19.5 cents a pound is where the sugar prices are trading right now. The rains in Brazil have increased prospects here as well, and the way the crude oil prices have declined, maybe not so much of cane will go for ethanol, but more for sugar. So the sugar production is expected higher in Brazil. Not just there, the Indian numbers continue to be stronger. Thailand harvest is on the positive side as well. So we have seen a bit of a turnaround when it comes to sugar prices and availability. So the price is here as well on the downtrend.
Okay, thank you very much for that, Manisha. Get into a break. On the other side, we'll discuss market technicals. Ashish Kyal, Wave Strategy Advisors, joins in next. Welcome back. Still down close to about 70 points on the Nifty. The mid-caps are down 80 odd points. That's a cut of close to about 0.25%. Well, for the last couple of days, we've been talking about the stalemate on Vodafone Idea. Right? On one hand, you've got the government who had committed to converting the interest on the AGR dues into equity, but they've not done so despite it being 1 year now. And there is no timeline. There is now no commitment that they are going to do it or not. So that's on one hand. On the other hand, promoters are unwilling, or they've not indicated whether they want to infuse some money. The government is saying promoters infuse the money. The company wants the government to convert its interest on AGR dues into equity. So there has been that logjam, a little bit of a stalemate that's been going on for a very long time. And consequently, the company has been unable to invest in 5G. But the problem is that the company has dues which are coming up. If you remember, Industars, this happened in the month of November as well as December. Industars kind of had written a warning letter to Vodafone Idea, pay up or otherwise the services will be affected, because Industar is a tower tenant for Vodafone Idea. And at that time, according to Vodafone Idea's repayment plan, they had said that till December quarter, we will continue with part payment. We will repay our Industar's receivable only partly. But from January, they had committed to making full payments, and they had also said that overdue receivables would be realized by July 2023. Well, we are in January already, which means that Vodafone Idea needs to now start making its full payments to Industars. But where is the cash coming from? And separately, if you remember that till September of 2023, that's 9 months from now, the company has debt of nearly 9,500 crore, which it needs to repay. This is the number that the company had quoted in this September when they came out with their Q2 numbers, that they have existing debt to the tune of 9,500 crore, which needs to be repaid by 2023. Even that preferential allotment to ATC, which the company wanted to do to convert the ATC dues into some sort of an equity at an eventual time, that also was pushed forward. This is the amount that's payable by September of 2023. The company's cash in the books is quite minimal at 190 crore rupees, and the debt is as high as 2.2 lakh crore rupees. So, you know, that's a little bit of an update that I wanted to give, that as the stalemate continues on Vodafone Idea, Industars is another one that you need to keep on your radar, because Industars is one of the important important operational creditors to Vodafone Idea, and the company owes dues to Industars, and Industars has been on their heels to get Vodafone Idea to make that payment. But let's invite Ashish Kyal, a Wave Strategy Advisors, on the show now to talk about the market technicals. Ashish, holding on to 17,900. So at least so far, we've not breached yesterday's intraday low. Your thoughts on the day so far, and what would be the approach to trade?
Hi, morning to you and all the viewers. If you look at Nifty weekly time frame chart, it's very interesting to see that since the top was formed around 18,890 odd levels in November 2022, since then we have not even tried to break above the prior weekly candle high. And so which means that the overall trend for the market over past few months has been sell on rise, over past few weeks has been sell on rise. And that is what we can clearly see even today's session. There was an attempt to go on the upside. We opened positive. There was some attempt on the upside, but again, the selling pressure started building up. And a very important level is 17,890. If we breach that level of 17,890, then we might be headed towards that 17,756, which is again support level. So I would use pullback to sell for a target of 17,756, as long as the high of today, which is around 18,050, remains protected on Nifty.
All right. And Ashish, what would you recommend in terms of some individual trades that someone could take right now?
From individual trade perspective, I would be looking for buying Mahindra CIE Automotive, because the stock has been moving absolutely independent to the broader market. It is bucking the trend, managed to find some support around that 20 days and 10 days average, bounce back from there. The volumes are decent enough. So looks like the stock is poised for the up move. And if there is some kind of a pullback that we see in the broader market, the stock should start outperforming again. So Mahindra CIE, one can create long positions here, keeping a stop loss of 336 for the target of 372. And the next stock is on the sell side is JSW Steel. After a good run up, we can see that the 20 days average is challenged. It is broken below that. Now that is acting as a resistance level on the upside. So looks like some profit booking in JSW Steel is possible. The stock can move lower over short term, expecting a target of around 684, and one can maintain a stop loss of 762 on the upside for JSW Steel.
Right. Ashish, what about Bajaj Finance? How are charts looking there?
Bajaj Finance, we can clearly see there was a huge selling pressure that was seen yesterday after around 6-7% down. And today, again, we are seeing that pressure continuing. So I'm not too optimistic, to be very honest, right now. I would rather use a pullback towards that level of 6,200 as an opportunity to re-enter on the short side. The support for the stock is placed around 5,780. So I think that is the level where someone can, looking from medium term to long term perspective, can start looking for buying and nibbling the stock. But right now, over short term, I think it is under pressure, might head towards 5,800 levels.
Okay, thank you very much for joining in. By the way, Landmark Cars is having a pretty good session. This is one of those recently listed companies. It's a retailer of cars. The issue price was 506, but when the stock listed towards the end of December, 23rd December, it had a muted listing. The stock listed at 471, but since then, from 471, we've seen the stock price climb to 565. So a near 100 rupee gain after opening below its issue price. So today as well, good gains, and it's coming in on the back of very strong volumes. So Landmark Cars is a big mover today. Get into a break. On the other side, we'll focus on some more buzzing stocks. Stay tuned.
Okay, welcome back. You're with us here on Trading Hour. IDBI Bank is the one that we want to just talk about. It's surging today after market regulator SEBI allowed to classify the government's post-stake sale holding as public shareholding. Why is that? Abhishek is here to explain that. Abhishek, over to you.
Well, as you mentioned, a bank will write to exchanges to classify government holding post the divestment as public shareholding. So the new acquirer of the bank has to meet the minimum public shareholding norms, which is about 25%. Now, post divestment, Government of India will not exercise control over the affairs of IDBI Bank. They'll also not hold any special rights with respect to the bank, and they will not be represented on the board nor act as a key managerial person in IDBI Bank. So voting rights of Government of India will not be more than 15% of the total voting rights, and reclassification as public with respect to open offer is being made by the new acquirer as well. Back to you.
Abhishek, thanks a lot for that. That is IDBI Bank up around 5%. One stock which is not doing well in trade, around 3% lower, is Trent. This after Kotak initiates coverage on the stock with a reduced rating. Mangalam is here to tell us more about that. Mangalam?
Well, that's correct. So this is the retail arm of the Tata Group, which houses brands like Westside, Zudio, as well as a partnership with Zara. But we know what the company does in terms of their business, etc. The interesting part about Kotak's initiation is that while they like the business as an opportunity, they believe that the valuations of the company are extremely rich. Factoring in a compounding of almost 28% of the company's on the company's top line and 32% jump in the company's net profit over the next 3 years, they still believe that the stock at current valuations trades at around 60 times December 2024 price to earnings, which is steep. As a result of which, basis their valuation metrics, they believe the fair value of the stock should be around 1,320 odd rupees. So that's the target price that they've set on the stock. Well, their target price is actually higher than the current market price of the stock. However, weakness in sentiment and reduced rating, limited upside is what is causing the stock to decline today.
Thank you very much for that. Let's move on and talk about real estate stocks. A whole host of companies have released their Q3 updates. Sonal is here with a compilation. Sonal.
Thanks a lot for that. Well, yes, it's a good update as far as Q3 updates from Sobha and Macrotech is concerned. Let me start with Sobha, which reported the best ever quarterly sales, both in terms of value and volumes as well. So Sobha's share in value is up 15.5%, up 22% on a sequential basis. Volumes for the company are up 10.5% on a quarter-on-quarter basis, up 12% on a YOY basis. Not only that, a huge uptick in realizations as well, up 11% YOY and 22% on a quarter-on-quarter basis. Across the board, we saw volumes getting better. Bengaluru still is the biggest market for them, which did see a slight decline on a YOY basis, but it was NCR which also contributed to gains this time around. Kerala was absolutely flat. We had Gift City too, which doubled its volumes on a YOY basis, and Tamil Nadu was the one which was again flat this time. The company says that projects from other cities have contributed 40% of the total sales volumes, and Gurgaon has achieved its highest ever quarterly sales this time around. Cash flows were also strong this time around, which has led to a debt reduction, and cash flows have continued to be very strong for last 8 quarters as well. So that bodes well for the company. For Macrotech, again, it is a strong update from the company. Pre-sales have gone up YOY, a slight decline on a quarter-on-quarter basis, but collections are up both on a YOY and on a quarter-on-quarter basis. We also have the 9-month figures, which are much better. In fact, for 9 months, the company has been able to cross the FY22 sales as well. Collections, however, just slightly lower than FY22, but the company is on track to achieve its guidance. In fact, the company says that they are on track to surpass the full year guidance of 11,500 crores. They added 4 new projects having 5 million square feet of saleable area with gross development value of 8,500 crore rupees. They've already added 17,800 crore rupees in terms of gross development value, which is more than the guided figure of 15,000 crore rupees. So that is also positive for the company.
Okay, so thanks very much for that. So that's updates coming in from real estate companies. Now, CEAT, the tire maker, is higher. Reports suggest the company is looking at a $2 billion revenue target in the near term. Sonia is here with details where CEAT is at in terms of revenues and where it wants to go. Sonia, over to you.
Well, thanks a lot for that. As you rightly pointed out, it's a $2 billion revenue target that CEAT has in the near term, which is about 15,000 crores. It doesn't look like a far stretch because with the kind of revenue growth that it has seen up until now, 15,000 crores is a reasonable assumption, although it will come from different segments is what CEAT believes. Currently, CEAT is a #1 player in the two-wheeler market, but they're looking to increase their presence in the passenger vehicle space as well as in the off-highway tire space. They're looking to increase their presence in the tractor segment as well. So they have mentioned that they've made strong gains in the European Union and the US markets over the last 5 years in farm tire manufacturing. Now, coming to the numbers, right, if you look at the FY22 revenues, they clocked in about 9,300 crores. On an average, they've been doing about 20 to 25% growth, which means that they could clock in 11,500 to 12,000 crores in FY24 and could reach that 15,000 target by FY25. In fact, Elara Capital says the expectation is that CEAT will touch $1.8 billion revenues by FY25 itself. The additional positive is a fall in both rubber and crude prices. Rubber prices are down 24% from April highs of last year. Crude prices are 40% lower. So this would mean better margins for them. Now, on valuations as well, you know, CEAT is cheaper than both its peers, MRF and Apollo Tires, if you compare it on an FY24 basis, and hence there is valuation headroom as well. Back to you guys.
Thank you very much. For that, we'll slip into a break. On the other side, we'll discuss the way forward for the markets with Mohit Batra, founder and CEO of Market Mojo. Stay tuned.
Okay, welcome back. Let's have the Nifty up quickly and take a look at what's happening. So the earlier rebound from the lows was sold into, although it's not going one way. We're down 60 points. That's about 1/3%, 17,933. Mohit Batra is founder and CEO of Markets Mojo. Is joining us now to talk markets. Mohit, good morning. Good to have you with us here. I guess first time we are interacting. I don't know if you've been with the on the channel before. But welcome on board. Before we get into the markets, Mohit, I mean, just tell us a little bit about Markets Mojo. It's a tool that I think all of us have used at one point or the other. You had, I think, an association with the Bombay Stock Exchange. I mean, we could find you on the BSE website at one point. The scale of operations, what you're doing, just a little bit of background would help. Go on.
A very good morning to you and good morning to all the viewers. Wish you a very happy new year to all the viewers of CNBC as well. Thank you for having me here. Just quickly, snapping around Markets Mojo, we are a research platform and a portfolio advisory platform. The differentiation that we bring in on the table is we remove the human biases. We go through data science, and we today cover 100% of listed markets in India. Apart from that, we also cover close to 21 countries across the globe, including US, Mexico, Canada, all sitting out here. So today, Markets Mojo has a real-time fundamental stock and portfolio advisory across over 60% of the global market cap.
So this is purely, you want to call, I don't know, you should call it AI, or it's machine-led. No, as you said, The only reason you're able to sort of cover all 100, all stocks, listed stocks, is because there's no human intervention, right?
Well, the base fundamental with which we work is that sooner or later the price reflects the movement of fundamentals.
Okay.
And hence a larger part of that is looking at the 10-year, 5-year trends of how the fundamentals are moving.
Okay.
We've just captured that under data science. We keep improving the weightages, because there's a lot of correlation and regression you need to do in terms of what the fundamentals are doing and how the price is moving on a day-to-day basis. And it's a self-adjusting system. So it just takes out the human bias on one side. It maybe catches stocks with a little bit of a lag, because we do wait for fundamental data to come out, although we look at valuations and technicals as well. But having said that, the system makes it more conservative, and the alpha generation that we've seen over the last 7 years since we've been operating is way higher than where the index is across any of the markets that we work with.
And where is this captured? Is it you sort of run a fund, or is this purely advisory? I mean, it's a paid.
No, we are.
Yeah.
So we have subscribers who subscribe, retail subscribers who subscribe to the service, and they can see our stock views. They can look at the stocks. They can look at the research reports. Our research reports are real time. So if you download a research report right now, it will have a stamp of this second.
Okay.
So they're that real time. And then we have a separate, business which is on the advisory side. We are a SEBI registered RIA, and we offer portfolio advisory to our clients. We currently look at over $1 billion worth of Indian equity advisory portfolios.
Mohit, morning. Rima here. So if you just purely look at the fundamentals of, say, a sector like technology, right, you would see that growth rates are fine so far because they are based on the deals which have been won in the prior quarters. You would say the margins are on an improving trajectory. So the fundamentals look intact. But the problem is the future, which is not captured in what the results of the September or December quarters are likely to show up. The risk is that budgets come under pressure, the deal wins slow down, which will result in growth slowing down. So how do you marry the two? And what would your call be on IT based on your analysis?
See, I think the holy grail out here is you got to wait, right? Because unless the fundamentals improve and unless the price traction and the valuations improve, we would not typically touch that. But having said that, there is always a futuristic outlook that we have. We typically do not marry that with the fundamentals because it's completely messing the system up, right? Because, if you remember 2008, classically, if you look at the hedge funds out there at that time, every hedge fund which runs on data science was talking about a huge sellout. But obviously, it was in the bull run towards the start and people didn't sell out, right? So it becomes very precarious a situation to marry the two, to have a human, bias towards what you feel, and then to run a system like ours. But having said that, what we are seeing today is a traction on the IT sector. I think clearly we have certain stocks that have started coming up in our buy list. So we are seeing that traction. And to try and carry forward the thought process of why they may be coming in is something that I can obviously, maybe throw some light on. I think, primarily against the contrarian view, the way our data is showing us is that there is a upward trend that is coming on the whole sector. If you look at the valuations, I think most of the things that we've seen that happened last year have been priced in. We personally believe, and as I said, my personal belief doesn't affect my stock ratings. But we personally believe that there is employee attrition which will come down. New contracts are being negotiated. Your depreciation of the rupee is going to affect in this year's P&L. And biggest thing is that the supply side constraints that were there the whole of last year have started easing out. So on and on of whatever the street view on IT is, we are extremely bullish on that. And the system has started just about capturing some of the IT companies that are coming in.
All right, that is on IT. Hi, Mohit. Good morning. This is Pavitra. So, based on your analysis, are there any pockets that you think are, poised to do really well in 2023? And, last year we had a lot of the themes like defense, like green energy, green hydrogen doing really well. Do you think those are things that could, really extend into 2023 as well?
Well, some of the sectors that are looking bullish as per my system is IT. We have, as I've already spoken about that. We've also got pharma, which has started looking good. The domestic demand of the pharma industry per se is showing a good upward linearness. So it is typically very strong. And we personally believe for long-term wealth creation, pharma may be a good sector to look out, not just in 2023, but moving forward as well. And the third sector, which is catching our attention, is the whole capital good and infrastructure. Now, if you look at capital good and infrastructure, since about 2008, the sector has not done that very well, right? But if you look at now, India's capacity utilization is as close to 75%. The capex is bound to come in. And also, typically speaking, just about prior to 1 year of the election, government wants to showcase the finished projects. And I think the capex will come in. Our call towards the second half of this year is that interest rates will start easing out. We may have a scenario where, the various federal banks will start cutting down the interest rates if the inflation comes in control. And I personally feel that capital good and infrastructure sector may do very well. The other sector that is looking extremely bullish as per our system is defense. Moving from the whole self-sufficiency of production, this is the first time that India has started exporting defense equipments. And that is looking very, very favorable for this particular sector. Clean hydrogen is a future technology and it's a future, system. We've currently not started capturing major companies out there. But if you ask me on a personal level, I think that sector is going to do very well moving forward as well.
Okay, all right. Mohit, thank you very much for your time. And, I'm going to check out the product, download a couple of, research reports and figure out how that works. Thanks very much. Appreciate you joining in. That's Mohit Batra of Markets Mojo with a quick conversation. We'll take a quick break, but as we do that, we'll leave you with some opinion from Mark Mobius of Mobius Capital. Okay, I think we'll play that bite out of Mark Mobius. We spoke with him in the morning on markets. He's extremely bullish in India. It's the number 2 weight in his portfolio. Snippet of that conversation post this quick break.
Welcome back. For the second day in a row, it's the Nifty FMCG index which is doing well and outperforming. So yesterday, remember, we had quarterly updates coming in from Marico and Godrej Consumer, and both of them seem to suggest that the industry demand picked up on the margin for the sector in the December quarter, and that's fueling a rally. So Britannia is higher in trade yet again. That's up close to about 1-odd%. ITC is gaining ground. That's higher by close to about 0.9%. Apart from that, life insurance companies are up and about. My colleague Surbi has been highlighting how life insurance companies are still trading about 10% away from their lifetime high levels. So HDFC Life, SBI Life for the last couple of days has been playing a bit of a catch-up. And then you've got strength in big boy Reliance Industries. So that's gaining in trade. On the losing side, IT is subdued and Bajaj Finance and FinServ under pressure for the second day in a row. As we wrap up on Trading Hour, here is some promised market opinion coming in from Mark Mobius, founder at Mobius Capital Partners. Thank you for watching this show.
India has outperformed everybody else is an indication of the incredible growth that you're witnessing in India now, which will continue in this new year. I believe that we're in a very, very sweet spot when it comes to India. A lot of things are going well for the country compared to other parts of the world. And despite the fact that you have recession fears in the US, the reality is that oil prices are coming down, and this is very good for India. And also, the Indian economy is doing very well on the back of the reforms that Mr. Modi is putting in place. There are going to be tremendous opportunities this year, and I'm looking forward to continuing to invest, not only in India, but in Taiwan, in Korea, and across the world. We're gradually decreasing the amount in Taiwan and increasing the amount in India. But of course, these changes take time because we're not big traders. We're not in and out of the market on a daily basis. So what we do is we gradually increase positions we have and maybe add some positions in India, while in Taiwan we may subtract and reduce the amounts that we have in some of the companies in Taiwan. There are a number of software companies we're looking at. We're looking at healthcare again, and also some of the more interesting specialized tech companies, companies, for example, that are doing mapping, companies that are doing consumer surveys, that sort of thing. I think what's happened is that because of COVID, a lot of people thought that, oh, these companies like Metropolis who are doing testing will do very, very well in a COVID environment. But then when the COVID is off the paper, then these companies will not do very well. So that's the reason why you've seen the decline.